how I would invest $1,000. So looking back to when I first saved my first $1,000, how would I invest that? So first, investing early at a young age is the most optimal time to invest, especially because you have a lower amount of money, and so you won't lose that much compared to when you're older. Now, if you are older and you don't know how to invest yet, or you're just getting into it and you're telling yourself, oh, I should have started earlier, well, don't say that. Just say that you're investing now, because the sooner you start investing, the longer time you will have to learn about the stock market and also make more money. I'm going to go over 5 things of how I would have invested my first $1,000. First, find a company that you really think is successful, that you really like. And this isn't a company that someone else likes or someone else says is popular. It's a company that you think is popular. And also make sure it's a very, very large company, because these companies have a lower chance of going bankrupt. And so this is not a company that other people think is good. It's just a company that you think is good. And if you have that sole belief that it is a good company, then you're going to have the responsibility when you start to invest in the stock. And this gives you the most experience, because when you have that responsibility of having your own money in something, you'll learn better, especially if you lose that money. Okay, second, spend $100 a month on buying the stock. Now, why would I just spend $100 a month on buying the stock instead of just buying the stock outright? Well, you'll buy more shares when it's lower, and you'll buy less shares when it's higher. And it's called dollar cost averaging, because the dollar amount that you spend is fixed and it does not change. And I like doing this, especially for beginners, is because you might be scared initially if the stock goes down, and you might not want to spend another $100, or it might go up and you might want to spend another $100. So spend $100 a month, feel how it is to just start putting your money into something. And also it's a good thing to do, because if you spend a lot of money on one stock and then you find something, or if you want to spend more money, well, you can't really spend more money because you already spent it. So by just spending money each month, you get that urge to spend money on stock out of the way. So I recommend doing this for 3 months and watch the stock very closely. So just read the news about it, look at the numbers at it, see how the stock moves day to day. It'll move up and it'll move down sometimes, and just don't think about that. Think about how it moves over a period of a month. So after you do this for 3 months, you'll have 30% of your portfolio allocated into the stock. You will get scared if you see it go down, and these are called paper losses, because you might seem that you lost money now, but it isn't actually made final yet until you sell the stock. And many beginners, including myself, get scared at paper losses because it is hard looking at, and also you might want to sell your stock. But just hold on to the ride, let it go, see what happens, and watch it very closely. Now, third, with 30% of your portfolio allocated to the stock, this is when you can start making your first decision. And this decision is very difficult. It is if you want to allocate more. Keep the stock as it is, or sell it. If you aren't confident in really making the decision, then just keep the stock that you have and watch it for a few months. See how the price moves for a few months. See how the market moves affects the stock, and make that decision to keep it, and then maybe research a newer stock. Okay, if you feel really strong about the stock and company, which I really hope you do, and you've been enjoying spending money on it, then allocate another $300 over 3 months. And if you do this, you'll now have 60% allocated to your portfolio into this stock. And usually this is a lot of money allocated into one stock, but it is just because it's only $1,000, it's not that much risk really, just because it's a low amount of money. If you made profit too, don't get too excited. I know you will, and I do every day if the stock goes up, but usually those are just good days, and it'll go back down. So gains and losses are not final right until you sell. Okay, on to the fourth point. Hopefully you allocated more to your first stock and you have 60% allocated. Now, once you have that 60% allocated, just hold it there. Watch it, pay attention to it. This gets you into, how the stock market moves, and it's more of a subconscious thing, but you can see it, and you might know how the stock moves. You might see that it moves, a few dollars a day. Sometimes Fridays it goes up a lot or it goes down. So if you feel strong, then you can start looking for a second stock. And this time, we're going to diversify slightly. And so what you can do to diversify is pick a company in a separate sector. And the sector is just an area of the economy, like banks or retail or real estate. So pick one in a separate sector than the first one you chose. Now with this one, you're going to allocate $100 a month again, but only for 2 months. So now you'll have a portfolio with 60% in your primary stock, 20% in your secondary stock, and 20% left in cash, which is also called liquidity. Cash is liquidity. And liquidity is very important, especially as a new investor, because sometimes you might need to take money out of your brokerage, or you might want to invest more into something that is doing really well, or you want to invest in something new that you found. And so just keeping a little cash on hand is very good to do as a beginner, because you'll have more options with cash. Now we're on to the final step. This is the 5th step, and this is the price that you find that you want to sell the stock at. And it's up to you. So, maybe you want a really big return and you want to earn a lot of money, and it might take longer to do that. And keep in mind, the average return on the stock market is usually around 8%. And a return is getting your money that you invested back and a little extra. So let's say you want to get an 8% return on the first stock you invested in. So 8% of $600 is almost $50. So when do you sell? Well, you sell when your stock that you paid $600 for is worth $650. And once you sell, that is a profitable return at 8%, and it's a great return. And now you successfully invested your first stock, and you got a really great return on it. Even if you didn't get a return this quickly, it's okay, because you can still hold that stock, and you can start putting more money in your brokerage and learning more about the stock market and making a better decision. But having this first experience is awesome to have, as well as it's exciting to invest your money, because that's when you're really starting. So that was the video. Hit the like button if you enjoyed it. I post early in the morning when the stock market opens or when the stock market closes, so you should definitely subscribe to get that video right when it comes out. Next video that's coming out is going to be how to save time, one of my more financial videos that I'm going to be going into. So look out for that, and also look out for the analysis I have on Sundays.